The last time both gold and silver moved like this, simultaneously, the dollar never recovered. Right now, as you are reading this, gold is trading above $5,278 per ounce. Silver has gained over 30% in 2026 alone, and for the first time in over 3 decades, the world's central banks collectively hold more gold than US Treasury bonds. That last sentence. Read it again. Not a rumor, not a prediction. A confirmed data point published this week. Something has changed. Not temporarily, not as a reaction to a news cycle. Structurally, permanently. And the people who understand what that means are not panicking. They are positioning. Quietly. Before the majority even realizes what is happening. Welcome to the boring currency. The one channel that does not shout. It simply shows you what the headlines are, too distracted to explain. Think of that one person in your life, the one who reads between the lines, the one who understood 2008 before the banks admitted it, the one who never guessed. They simply watch the numbers. That is what we do here. So, do us a favor. Hit that subscribe button, not for algorithms, because the next time a moment like this one is unfolding in real time, you will want to already be here. And drop a comment below. Tell us where in the world you are watching this from tonight. London, Lagos, Lahore, Sydney, New York. This story does not respect borders, and neither should the people paying attention to it. Now, let us get into what is actually happening. The year is 2026, and the word crisis is finally too small for what we are watching unfold. Silver started this year at approximately $66 per ounce. As of this week, it is trading near $88. That is a 30% gain in less than 60 days. But here's the part the financial media keeps glossing over. This 30% gain in 2026 comes after silver already surged 147% in 2025, before this year even began. A metal that was trading at $28.92 in January 2025 hit an all-time peak of $121.64 per ounce in late January 2026. That is a 320% move in 13 months. And the mainstream financial press is still calling this a commodity rally. It is not a commodity rally. It is a verdict on the dollar, a verdict on government debt, a verdict on a financial system that has been printing promises for 50 years and is now being asked to honor them. The numbers are doing the talking, and what they are saying is uncomfortable. Let us start with gold, because gold tells the story that silver is now confirming. On January 29, 2026, gold hit an all-time intraday record of $5,595 per ounce, $5,595. 1 year ago, gold was trading below $2,600. That means gold has more than doubled in 12 months. Not a tech stock, not a cryptocurrency, not a meme. Gold. The oldest, most boring, most conservative store of value in human history. More than doubled in 12 months. And right now, today, as of February 28, 2026, gold is trading at $5,278 per ounce. It pulled back from the January high. The margin hikes, the forced selling, the Kevin Warsh Federal Reserve nomination news all created temporary paper pressure. But notice what gold did not do. It did not go back to $4,000. It did not go back to $30,500. It did not surrender the $5,000 level permanently. It held. It consolidated. It rebuilt. And every major bank on the planet has now revised their gold forecast upward. J.P. Morgan sees $6,300 by year end. Bank of America sees a clear path to $5,000 sustained. Yardeni Research, one of Wall Street's most respected forecasting firms, is calling $6,000 before 2026 ends. UBS projects $5,400 under continued geopolitical pressure. These are not fringe predictions. These are the largest financial institutions on Earth, and they are all pointing in the same direction. But here is the question nobody is asking loudly enough. Why is gold doing this right now? Not why is gold going up? We know the surface answers. the deeper question: why is gold behaving like this in 2026 specifically? The answer requires understanding something called the debasement trade. For 50 years, the global financial system ran on a simple belief: governments borrow money, they print currency to service that debt, and the world accepts those paper promises as valuable because the United States has never truly defaulted. The system has always held. But in 2026, something cracked, not broke, cracked. The U.S. national debt has now surpassed $37.8 trillion. Let that breathe for a moment. $37.8 trillion. And here is what makes that number genuinely alarming in 2026 specifically. The United States government is now paying more in annual interest on its debt than it spends on national defense, more on interest than on its entire military every year, every single year. A larger and larger portion of every tax dollar collected goes not to schools, not to infrastructure, not to defense. It goes to paying banks and foreign governments interest on borrowed money. And the debt is still growing. Trump's proposed budget legislation, called the One Big Beautiful Bill Act, is projected to add several more $1 trillion on top of what already exists. There is no plan to pay this down. There is no mathematical scenario where this resolves without either printing enormous amounts of new money or accepting a dramatic decline in the dollar's purchasing power. Both paths lead to the same destination: gold above $5,000, silver above $80, and eventually much higher. This is what traders mean when they say the debasement trade. It is not speculation, it is arithmetic. But the debasement trade only explains part of what is happening, because there is a second force at work, one that is arguably more significant than anything the United States does domestically. Central banks are abandoning the dollar as a reserve asset, systematically, deliberately, at a speed that has not been seen in modern financial history. Here are the numbers. In 2025, the world's central banks collectively purchased over 1,100 tons of gold, the third consecutive year above 1,000 tons. Poland alone approved a plan in January 2026 to purchase an additional 150 tons of gold. Their target is 700 total tons. Their goal is to hold gold at over 30% of their total national reserves. The Reserve Bank of India has allowed gold to reach 16% of its total foreign exchange reserves, a record high. Brazil re-entered the gold market in late 2025, purchasing 43 tons in a single quarter. China's People's Bank has been a net buyer for 15 consecutive months. And here is the number that changes everything. For the first time in over 3 decades, the aggregate gold holdings of the world's central banks are now worth more than their collective US Treasury holdings. Read that again slowly. The world's central banks, together, hold more gold than American government bonds. This is not a trade. This is not a hedge. This is a structural withdrawal of confidence in the dollar as the primary reserve asset of the global economy. This is de-dollarization in motion, not in theory, not in academic papers, in the actual balance sheets of the world's sovereign institutions. And when central banks move, they do not move for short-term gains. They move on decade-long strategic calculations. They move when they have already decided the decision has already been made. Now, let us talk about silver, because silver in 2026 is telling a different story than gold, a more urgent one. Gold is a monetary story, a story about confidence in currencies and government promises. Silver is a different kind of crisis entirely. Silver is both a monetary metal and the most industrially irreplaceable commodity on Earth. Every solar panel, every electric vehicle, every 5G tower, every AI data center, every missile guidance system, every smartphone, every medical device, silver. There is no substitute, not at scale, not at the conductivity, reflectivity, and malleability that silver provides, and the world is consuming silver faster than it can mine it. The numbers are stark. The silver market entered 2026 in its 5th consecutive year of structural deficit. 5 years in a row where global demand has exceeded global supply. Mine production has not grown, it has actually declined. From roughly 1.07 billion ounces in 2010 to approximately 1.03 billion ounces today. Meanwhile, the International Energy Agency projects that meeting global climate targets requires 250 million additional ounces of silver per year by 2030. That is 250 million new ounces needed annually, on top of what is already being consumed. From a supply base that is shrinking, the deficit in 2026 alone is expected to reach approximately 200 million ounces. 200 million ounces deficit this year. This is not a market imbalance. This is a structural crisis in slow motion. And then China did something that almost nobody in the Western financial media has fully explained. China controls 60% of the world's silver refining capacity. The raw ore comes from mines in Mexico, Peru, Russia. But a majority of the world's refined silver, the kind that can actually be used in industrial production, passes through Chinese refineries. In 2026, China began restricting refined silver exports, not banning them entirely, restricting them, the same way they restricted germanium and gallium exports in 2022, the materials needed for semiconductors. Western manufacturers scrambled for 18 months to find alternatives, prices spiked, production delays cascaded. Silver has no alternative, not for high-conductivity military-grade applications, not at scale, not on any timeline that matters for the industries that depend on it right now. When China restricts refined silver exports, the rest of the world can no longer use Chinese supply to plug its deficits. The shortages that were previously papered over by drawing down above-ground inventories are becoming an overt supply crisis, and here is what makes it worse. The silver that exists above ground, the stockpiles sitting in vaults in London and New York, has been steadily declining for years. When those inventories run low and industrial buyers cannot secure physical supply, there is only one direction for the price to move. This is not a prediction. This is supply chain reality. Now, let us talk about what is happening at the paper versus physical level, because this is where the real story lives. There are two versions of silver that trade in this world: paper silver, futures contracts, options, derivatives, digital numbers on a screen. Silver that represents silver but is not silver. For every 100 ounces of paper silver that trades on exchanges like COMEX, only approximately 1 ounce of actual physical metal exists behind it. Physical silver, real bars, real vaults, real weight, real scarcity. These two versions of silver are telling completely different stories right now. Paper silver crashed 41% in the January 2026 correction. On the screen, silver looked destroyed. But physical silver premiums in Asian markets during that same crash spiked to 29% above spot price. 29% premium. That means buyers in Asia were willing to pay 29% more than the crashing paper price just to secure actual metal. Not contracts, not promises. Real silver. This is what experts call dislocation. The moment when the price on a screen no longer matches what real buyers in the real world are willing to pay. And dislocations of this magnitude do not resolve themselves quietly. They resolve violently. When physical buyers exhaust available above-ground supply, when industrial manufacturers face actual production shutdowns, paper prices have no choice but to catch up. History has shown us what happens next, every single time. Goldman Sachs currently forecasts silver averaging between $85 and $100 per ounce in 2026. Citi has issued a target of $110 for the second half of this year, citing acute shortage of physical silver available for immediate industrial delivery. Gold Silver's lead analyst expects silver to trade above $100 in 2026 as supply deficits deepen. And macroeconomic strategist Tom Bradshaw has made a statement that is difficult to dismiss. He predicts silver at $375 per ounce by 2028. His reasoning is not based on hype. It is based on simple mathematics of a structural deficit compounding year after year with no credible supply solution. But here is what most people are missing about these price predictions. They are not just about silver being cheap or oversold or technically due for a bounce. These price levels are a signal about something far more fundamental. When silver quadruples in price, when gold doubles, when the world's most conservative sovereign institutions dump treasury bonds and buy physical metal instead, they are all saying the same thing. The currency system is under structural pressure it has never faced before, and that pressure is not going away. Let us be precise about what that pressure actually is. The Federal Reserve is caught in what analysts are calling a policy trap. U.S. GDP growth has slowed to 1.4%. Inflation remains stubbornly above the 2% target. If the Fed cuts rates to stimulate growth, it risks an inflationary spiral made worse by the new tariff regime. If the Fed raises rates to fight inflation, it risks triggering a deep recession with $37.8 trillion in debt that becomes impossible to service at higher borrowing costs. There is no good option. There is no clean exit. This is the exact environment that historically has sent gold and silver into multi-year bull markets. The late 1970s stagflationary environment produced gold's most dramatic run in modern history, from $40 to $800. But there is a critical difference between 1979 and 2026. In 1979, U.S. debt was manageable. Paul Volcker could raise rates to 20%. He could break inflation because the economy could survive the pain. In 2026, U.S. debt is at $37.8 trillion. The government cannot afford 20% rates, cannot afford 15%, cannot even comfortably afford 10%. The tools that worked in 1979 are no longer available, and every serious analyst who understands this knows what it means. The dollar will weaken, not because of politics, because of mathematics, and every dollar that weakens transfers value from paper into things that cannot be printed: gold, silver, physical assets with finite supply. This is not doom. This is arithmetic. Now let us connect all three threads. Because individually, each piece of this story is significant. Together, they form something undeniable. Thread 1. Gold above $5,000 is not a peak. It is a new floor. J.P. Morgan, Bank of America, Yardeni, UBS, Goldman Sachs. Every major institution has revised their target upward. The structural drivers, central bank buying, de-dollarization, fiscal dominance, they have not reversed. They have accelerated. The BRICS gold-backed currency pilot program launched October 31, 2025. As of December 2025, BRICS nations controlled approximately 50% of global gold production. That is not a trend. That is architecture. An entirely new monetary architecture being built in real time, with gold at its foundation. Thread 2. Silver's deficit is not cyclical. It is structural and deepening. 5 consecutive years of demand exceeding supply. Chinese refinery restrictions tightening global availability. Industrial demand from solar, AI, defense, and electrification growing faster than any supply response can match. Physical premiums in Asia screaming that real buyers see a price far above what Western paper markets currently quote. The math of 200 million ounces of annual deficit compounding year after year leads to only one conclusion. Thread 3. The Federal Reserve is trapped. The U.S. government's debt is unpayable without either printing enormous amounts of new money or accepting a dramatic decline in the real value of the dollar. Both paths are inflationary for hard assets. Both paths are bullish for gold and silver. There is no third path that resolves this cleanly. The window for a clean resolution closed years ago. What remains is not whether precious metals rise further. What remains is only the question of speed. 3 threads. 1 conclusion. The currency crisis that economists have debated as theoretical for 2 decades is no longer theoretical. It is the price on your screen. right now. So what do two scenarios look like from here? Scenario 1. The structural forces hold. Central banks continue buying. BRICS monetary architecture continues developing. The Federal Reserve is unable to raise rates meaningfully without triggering a debt servicing crisis. Silver's physical deficit continues deepening. In this scenario, gold tests $6,000 by year-end, as J.P. Morgan predicts. Silver breaks $100 as Goldman Sachs and Citi both project. The physical shortage becomes a front-page story that can no longer be explained away. The 91% premium between Asian physical prices and Western paper prices forces paper markets to reprice dramatically upward. Physical holders are validated. Paper traders are exposed. Scenario 2. A diplomatic breakthrough in Geneva reduces geopolitical risk premium temporarily. Kevin Warsh, as new Federal Reserve Chair, pursues a hawkish inflation-fighting mandate, strengthens the dollar in the short term, applies temporary downward pressure on metals. Paper prices correct toward support levels. Gold pulls back toward $40,800. Silver retraces toward $75. But here is what is critical to understand about Scenario 2. A pullback does not change the structural reality. The debt is still $37.8 trillion. Central banks have not reversed their gold buying strategy. The silver deficit does not disappear because paper prices correct. The BRICS monetary architecture does not dissolve because of one diplomatic session. Scenario 2 is a delay, not a resolution. And historically, the last time a delay appeared in a structural metals bull market, it was called an opportunity by the people who understood what was actually happening. The 1970s proved this. Gold corrected 47% in 1975 from 195 to 103. Many declared the gold bull market over. Those who sold missed the subsequent run to $800. The metals that correct 30% in structural bull markets do not announce themselves as opportunities. They feel like confirmations that the bulls were wrong until the next leg begins. Watch three things in the coming weeks. Watch whether gold holds above $5,000 through sustained trading, not just a spike, a floor, a defended level. If $5,000 becomes the new base, that changes every institutional risk model on Earth. Watch Shanghai silver premiums. If physical premiums in Asia remain above 20%, the dislocation between paper and physical has not resolved. The pressure on COMEX to reprice upward remains intact. Watch central bank purchase announcements. Poland has already committed to 150 more tons. India's next quarterly disclosure will show whether their 16% allocation is growing. These are not market moves. These are policy signals. And policy moves slower than markets, but hits harder when it arrives. The people who are positioning right now are not doing so because they are excited about metals. They are doing so because they understand what the numbers are already saying. $5,178 gold is not a prediction that came true. It is a warning still in progress. The currency crisis that gold and silver are pricing in has not fully arrived yet. The prices are running ahead of the event, not because traders are irrational, because the smart money understands what is coming before the headline writers admit it. $37.8 trillion in debt does not resolve quietly. A world where central banks hold more gold than US Treasuries does not return to dollar dominance without a fight that the dollar is unlikely to win. A silver deficit of 200 million ounces per year does not disappear because paper traders take profits. The data has spoken. It has been speaking for months, getting louder with every week. The only question that remains is whether you are watching the numbers or waiting for the news. The people who wait for the news are always the liquidity for the people who read the numbers. That wealth did not disappear. It transferred from those who trusted the official story to those who trusted the data. The numbers do not lie. They simply wait to be understood.